Good day friends and welcome back to the channel. There are multiple ways to own a piece of commercial real estate. The two most common ones are a REIT and a syndication. Today, I'm going to go over what are the pros and cons of a REIT and how is it different from a syndication. If you haven't already, please check out our video about what a syndication is all about. I'll also post the link in the description below. That leaves us with REITs. A REIT, or a real estate investment trust, is a company that buys income-producing real estate assets. In order for a company to be classified as a REIT, it has to follow certain guidelines established by Congress. Some of which are, a REIT has to pay a minimum of 90% of its income to shareholders. Another is that 75% of its income must come from rents, interest from mortgages, and from the sale of assets. Also, 75% of its total assets must come from real estate. And lastly, the entity must be taxed as a corporation. Let's jump into the benefits of owning a REIT. First is the low capital requirement. As you can see, you can buy a share of Annaly Capital Management Incorporated, ticker symbol NLY, for $6.61 at the time of this video. Second, consistent dividend payout. As previously mentioned, one of the requirements of a REIT is to pay out 90% of its income to its shareholders. Third, a share buys you multiple assets. By default, you are diversified when you buy a share of a REIT. Here's what I mean. There are certain REITs that buy only to a specific asset class. There are REITs that only buy into hotels, hospitals, apartments, and even cell towers. And each of those REITs can own multiple of those assets at the same time. Lastly, it is liquidity. Simply put, you can sell the shares of your REIT when you want to because there's a market ready to buy those shares. There is no financial vehicle that doesn't have a downside, and REITs are not an exception to that rule. So here are some of the disadvantages of owning a REIT. For one, there is minimal tax advantages. Dividends from REITs are taxed at ordinary income rates, not unless you own those shares through a tax advantage account such as a 401k, a Roth IRA, or an HSA. The taxes on those dividends can be significant depending on your tax bracket. Another disadvantage is that you do not have direct access to the fund managers. Now, this is typical for most stocks anyway, but if you're buying significant shares from a company, wouldn't it make a difference if you have direct access to the managers and hear it directly from them what is the current business plan and get direct updates as well? Now that we have an understanding of what a REIT is, let's do a head-to-head comparison between a REIT and a syndication. Let's start with capital requirements. I would give this round to REITs because of the low barrier to entry. Most syndications have a minimum investment of $25,000. Let's move on to dividend or cash flow. This one is a tie. Although REITs consistently distribute a dividend, a syndication has something called a preferred return, which depending on the syndicator distributes them quarterly, semi-annually, or annually. As for tax advantages, this one goes to syndication. Some of the tax benefits you get from investing in a syndication are depreciation, mortgage interest deduction, 1031, refinancing, and carried over losses. If none of these are familiar to you, don't worry. I'll explain all of this in a future video, so stay tuned. Let's move on to liquidity. As mentioned before, REITs are very liquid. Keep in mind, liquidity is not always a good thing. When an asset is easily bought or sold, its price or value is very volatile. There's no telling what its price would be today, tomorrow, or next week. This next category is easily the biggest difference between the two. A REIT holds more assets at any given time, while it's not as common in a syndication. Now, a syndication deal can buy a portfolio, but it's nowhere near as a REIT. Not only that a REIT owns multiple assets, it can also own multiple assets in multiple cities at the same time. A typical syndication owns assets in a specific location. Lastly, you have direct access to managers or sponsors in a syndication. If it's a 506B deal, by law, you must have a substantive relationship with a sponsor. In other words, you must have a prior relationship with a sponsor prior to you having knowledge of the deal. That said, your line of communication with a manager is more direct in a syndication than in a REIT. And that about rounds up our comparison between REITs and syndication. Hopefully, after this video, you are more informed on which one to invest in if you want exposure in real estate. I hope you enjoyed this video. Please leave your questions in the comments below. I wish you all the best in your investing journey, and I will catch you on the next one.